Okay, so let us try to
Good morning,
understand.
ma'am.
Good morning. Good morning, everyone, again. Now, let us try to understand some more concepts in national income accounting. Okay, before we go to the three methods, there are some more concepts left for us to understand. Yesterday, I told you that in order to calculate national income, in order to avoid double counting in national income, there are some activities which are not included in the GDP calculation. Please remember that whatever we will discuss, that depends on the definition which we have taken. So very beginning we have defined GDP as the value, the money value of all final goods and services produced in a given year. So when we say given year, it means that we are only including the economic activities which are taking place in the current year. So any economic activity which is of the previous year, which is related to previous year, or which has anything related to the previous year, is not included in the GDP calculation. That is important for us to understand. And because of that, there is another important fact which creates problems and lot of debates in national income accounting. That is what happens to transfer payments. So transfer payments are not included in the GDP or GNP calculation, but is a part of but is a part means that it is included in personal income calculation. So you will see that when we are talking about GDP or GNP, GNP is related to the current year. GDP, GNP or GDP is related to current year's activity, current year's economic activity only. So therefore, subsidies, gifts, interest on government bonds, resale or purchase of old property, share market activities, inventory of previous year, When you say inventory, inventory means unsold stock. Unsold stock is not added to current year's GDP. So there are two important things when you are talking about GDP and GNP calculation. One is the fact that non-market activities are not the part of GDP GNP calculation, or non-market activities does not get reflected in GDP or GNP. So countries which are more dependent on non-market transactions or transactions outside the market, they are actually not able to show their GDP properly. Second important point is that GDP, GNP is related to only current year's activity. So therefore, all these things listed here, subsidies, gifts, uh, interest on government bonds, these are not part of your GDP. Why? Because they are not at all related to current year's economic activity. So anything which is not related to current year's economic activity, maybe it is a transfer payment. You received a gift from someone, you received charity from someone, you received various types of allowances from the government. Okay, food subsidy, export subsidy, fertilizer subsidy. There are a lot many things which are taking place in the economy. Free ration or transfer of some income by the government. So that is not included in GDP calculation because GDP is the nation's income. Okay, it can be part of individual income, but it cannot be part of the nation's income. So is it okay? Are you able to understand this?
Yes, ma'am.
Yes, ma'am.
As we are moving further, we will discuss these things more. But for now, remember that every allowance which the government makes, whether it is Vidwa Pension Yojana, whether it is through Jan Dhan Yojana, or whether it is through any type of benefit transfer, that does not gets counted in the GDP calculation because it is not related to any economic activity. Anything which is not related to current economic activity or anything which is not due to any economic activity, like you participate in a contest and you receive a gift or you receive a prize. So that contest was not an economic activity. Okay, so all the activities related to recreation or entertainment, just for the sake of entertainment, if you are doing something, that is not the part of economic activity. Now, when we have talked about this, let us talk about some more concepts. So you start with GDP or GNP. And then what you do, you deduct GDP, you deduct depreciation from GDP or GNP. Depreciation, GDP minus depreciation or GNP minus depreciation will be equal to NDP or NNP. Now this is net national product or net domestic product. So depreciation is what? Depreciation is also known as capital allowances or you simply say this is this is due to wear and tear of capital, wear and tear of capital, wear and tear in the capital stock. Or you can also say the depletion of value or production capacity in a particular asset which takes place in a current year, in a given year, that is depreciation. Like suppose you are using some machine, so machine, as you use the machine in the production process, there is some wear and tear taking place in the machine which you have to get replaced, or which you have to uh, get redone. So the expenditure on this wear and tear of capital stock, which is known as depreciation, is not included GDP when we are calculating the net. Because what happens that when you are talking about total GDP, there are a lot many equipments which you are using over the time period. Every capital equipment you don't use for 1 year only. There is a lifetime of capital stock, and are several factors which have a lifetime. So if you are using some factor of production for more than 1 year, then after the first year, from the next year onwards, there will be some maintenance expenditure occurring on that capital stock or asset. So that maintenance expenditure, which is known as depreciation, particularly for capital stock, that is deducted from GDP to get the net amount. Okay, so this was one thing. So it means that gross is always equal to gross is always equal to net plus depreciation, or net will be always equal to gross minus depreciation. Okay. Now another concept. So you started with GDP. Now what happens that if you start with GDP and then suppose you deduct indirect taxes, okay, and you add subsidies here. So what you get is national income. So when you say GDP, GDP is not actually national income. But GDP is the gross value of the output for the economy. Now, from this output, if you deduct indirect taxes and if you add up subsidies, that will give you national income. There is another way to understand it. GDP, GNP minus depreciation please pay attention to this, okay, because these things create lot of confusion. So try to understand as I am trying to tell you. GNP minus depreciation is net national product. Now, this net national product can be understood in two ways. There can be GNP, FC, or GNP, MP. Similarly, NNP at FC or NNP at MP. Now, FC here means factor cost. MP here means market price. So, factor cost means based on factor payments. Okay, which includes subsidy. Market price means market price current market price, which includes indirect taxes. So GDP is different from national income. Okay, national income is another identity of macroeconomics or another macroeconomic identity. You have GNP and you have national income separately. When you say national income, generally it is NNP at factor cost. National income is always equal to NNP at factor cost. Okay. Now, what is factor cost? When during the production process, you are using various factors of production. You are using labor, land, capital, organization. So all the goods and services used during the production process can be seen from two sides, or can be analyzed or can be counted from two sides. One is how factor payments are made at different steps of production, what factor payments you are making. So that if you take from that prices, if you calculate, if you count the GDP from the basis of the factor payments made, then you include the subsidy there, because you are paying the subsidy to the factors of production. So factor cost, any national income accounting variable which is at factor cost, then it means it includes subsidy. Any national income accounting variable which is at market price, that means it does not include subsidy, but it only includes indirect taxes. So market price means it is inclusive of tax. As you have seen on every product, you say that MRP, maximum retail price, which is inclusive of taxes. So market price is always inclusive of taxes which are indirect. Okay, taxes which are on consumption, which are on sales. This is not income tax, but these are the taxes which are only on the consumption side. So this is one important difference. Okay. Any question? Any clarification? You will be understanding gross and net after a bit, because when we are talking about output method of national income accounting, I'm definitely talking again about this. But just
and please tell us about the depreciation.
I'm not getting your voice properly.
Ma'am, please once tell about depreciation.
Depreciation, suppose you purchased a say you purchased motorcycle and the total value of motorcycle is 55,000. Okay. So now this is first year. When you have purchased, so this is the first year. Now in the second year, the value of motorcycle, if you try to sell this motorcycle in the market, the value which you will be getting will be maybe 45,800, not 55,000. You cannot get 55,000 in the second year if you are selling the motorcycle. Okay, why you are not getting? Because when you purchase this asset and when you use it, over the time period, there is some decay in the capacity of this motorcycle. Because when you will run the motorcycle, the engine will get used up, the other equipments in the other parts in the motorcycle gets used up, and therefore there is a decay. There is a loss of capacity for which you continuously do servicing. Okay, जो भी हमारे व्हीकल्स होते हैं उसमें हम लगातार सर्विसिंग करवाते हैं एक रेगुलर इंटरवल पे. Even suppose you have a bicycle, then you have to put grease on the chain. You have to clean the bicycle. Sometimes you know that there is no air in the tires. So that's how you keep on spending some amount on this asset. And as you will move further, the value will keep on decreasing. Third year, if you are trying to sell it, or the actual market value of this motorcycle, which was 55,000 in the first year, maybe in the third year, it is becoming only 42,000. So over the time period, the value is decreasing because of the decay in the motorcycle or decreasing capacity. So how do you calculate this? So every year, the expenditure which you make on maintenance of this motorcycle, that is one indication for calculating depreciation. But at the company's level, try to think about your economy where different companies are there. Different companies are using different types of machines and equipments, buildings, land. Okay, there are different types of natural resources which we use during production process. So production capacity used up means which is decaying. Used up means decaying during the production process. Is your depreciation. Is it okay? Are you able to understand this?
Yes, ma'am.
Yes, ma'am.
Someone is writing that when you use the mobile phone, it means wear and tear. It is not when you use any item. What happens that when you use the production capacity or the capacity of that instrument or that equipment or machine or building gets less and less over the time period. Every capital asset has a lifetime. Okay. Even suppose you talk about your house or the place where you are living. If you will not maintain that house, there will be a decay in that house or there will be wear and tear taking place. So same thing is applicable for the whole economy. So in the whole economy, all the capital assets will have wear and tear. So if you want to calculate the net value, you have to deduct the wear and tear. So now let us see this. You
Excuse me,
start
ma'am.
from GDP.
Ma'am,
Yes.
what is
What
gross,
happened?
ma'am?
Ma'am, kindly move to the first slides. Actually, there was a network issue at my end.
First slide. Okay, let me see this. Which was the first slide? First slide was this.
Yes,
Are you talking about this?
yes, ma'am. That was something little personal.
This was the first slide. Okay. Then this was the second slide.
Ma'am, here what is gross, ma'am?
See, yesterday also I was telling you that if you are suppose making, you are talking about a bakery or a bread factory. So when you talk about bread factory, you know that there are various production stages. So if you add up the value at each production stage, what you get is gross. You count the value of wheat, then you count the value of wheat flour, then you count the value of all the raw materials and equipments, then you count all the value of marketing and other items which we are using, and then you count the value of final bread which you are making. So if you add up all the values together, you will get the gross value. Okay, so we'll understand this in the coming.
What is dollar value?
Are you saying anything? I'm not getting it
Yes,
properly.
what is dollar value?
What is
Dollar value.
dollar? What is dollar?
Ma'am, dollar value, ma'am. Ma'am, in Paul Samuelson, ma'am, GDP is equal to C plus I plus G plus X, where, ma'am, it is written, ma'am, C equals dollar values of consumption. So, ma'am, I'm little bit confused the word dollar. What is dollar values of consumption?
Are you saying this?
Yes, ma'am. Yes, ma'am. Dollar.
Dollar. What? When you say dollar, what it means? You know, dollar is what?
Ma'am, it is a currency.
Yes, it is a currency. So US currency. So whichever country you are talking about, you're talking about dollar, it means it is a US currency. So for USA, if you are calculating the GDP, you are saying Y is equal to C plus I plus G plus X minus N. So what you are doing is you are taking all these value in dollar terms. You will not be adding the quantity, but you will be, I told you, market value. So when you say market value, it means you are multiplying the quantity by price. Now, which price you will be taking, it depends on which country you are. If you are talking about India, you will be talking about rupee value. So you are expressing all the variables in rupee terms. You are expressing all these variables in dollar terms if you are talking about USA. You will be expressing this in euro terms if you are talking about European economy. You will be expressing this in pound sterling if you are talking about Britain. If you are talking about Japan, then it will be yen. If you are talking about Italy, it will be lira. So that's how you calculate. Okay. Now see this. You started from GNP. Now suppose this is GNP at factor cost. Then you deduct depreciation. So you arrive at NNP at factor cost. Now this NNP at factor cost is equal to national income. So you can see there are three concepts now. 1, 2, 3. Okay. Now from national income, what you are doing? Now be very careful, okay? Be very attentive now what I am writing. Now from NNP at factor cost or your national income, what you have to deduct? You deduct undistributed profit, you deduct corporate tax, then you deduct social contribution, by the employer, then you deduct social contribution.
Ma'am,
Instead of calling it social contribution, you call it social security contribution. What you are saying?
Ma'am.
Someone is
It is
saying
not
something?
appearing.
Ma'am, what are you writing? It is not coming, ma'am.
the whiteboard is actually got freezed.
Is it okay? Are you able to see this?
Yes, ma'am. Now.
Yes.
Yes, ma'am.
So maybe because of the network issue.
Ma'am, what is the third
So-
point?
Third is your national income. So these are three different concepts of national income accounting. One is GNP at factor cost, another is NNP at factor cost, the third is national income. Okay, these three things are different, they are not same. So how do you get national income? You have to deduct depreciation from GNP, and that's how you get national income. National income is just same as NNP at factor cost. But you have to understand that when you talk about national income, subsidies are added and indirect taxes are excluded. Okay? And please wait for some time to understand indirect taxes more, because again we are going to talk about this in the coming days. And I told you that at any point of time, if you are not able to understand anything, maybe you can just refer to the to my previous class videos. Maybe it will help you more. Social security contributions. By individuals or employees. Okay, so all these things you are deducting. Now you have to add something. Plus, now what you will be adding? Transfer payments to individuals plus transfer payments to individuals by government transfer payments to individuals by firms. Then you add interest payment by the government and interest payment by the individuals to firms or government. If you add up all these things and you deduct all these things from NNP at factor cost or national income, what you are getting is personal income. So personal income is different from national income. Personal income means all the income which is actually going to the individuals. GDP was related to, GDP or GNP is related to the total value of output at the country level. Then from that total output, you calculate your national income. Then national income, you deduct few things in national income and you add up few things to the national income, and then you are getting personal income. Personal income is the income earned by the individuals. Income earned by the individuals. Then what you do? From personal income, you deduct personal taxes. Personal income minus personal taxes is equal to disposable income. Disposable income, which is shown as YD. Disposable income, the income which is available in the hands of individuals for spending, that is disposable income. So your personal income and disposable income may differ because the income available for spending in any given year is different from your total income. Now this disposable income is written as YD is equal to C plus S. Disposable income is equal to C plus S because this disposable income is now distributed as consumption expenditure and savings. So you consume out of your disposable income and you save out of your disposable income. That means you have already deducted the personal taxes, and these personal taxes are mainly income taxes. Right now, if you are talking about these personal taxes, you pay income tax from your total income. You pay service tax from your total income. After paying all the taxes to the government, now what you are left with this? Is it okay?
Yes, ma'am.
Yes, ma'am.
See this?
Ma'am, what is interest payment by the government?
See, suppose you have done, you created FD in the bank. So interest payment on bonds, FDs, securities by the government. Which goes to individuals or firms, whosoever has purchased this bonds FD. You have created a savings account in your post office. You have created a FD in your in your bank, or you have invested in Kisan Vikas Patra, or you have invested in these various instruments where you have the deposit the money for long term. Okay, we are not talking about your bank account through which you withdraw money every time, but we are talking about the savings which you have done in form of some paper where you have invested the money for a given time period. So government, because that is a government instrument, so government is paying back the interest rate to you. So that interest payment which government makes every year or every quarter or every 6 months, that is not part of GDP, but that is part of your personal income. So in the national income, you add the interest payment. Okay.
Okay,
See,
ma'am.
there is a difference in terms of interest payment, which we are again going to talk. I'm telling you, this is a brief background which I'm telling you. I'm right now explaining to you. Next, when we are doing these methods, we will talk about everything again. So please don't worry. Let me finish this. Okay. So you have
Hello, ma'am.
Yes.
Ma'am, please see the previous.
What?
Ma'am, please see the previous board. What you have written.
Previous board, you are saying?
Yes, ma'am. Slide.
Last slide.
Okay. What do you do actually? You take a photograph every time? Why don't you write? And I'm telling you again and again, please be attentive. If you miss something, you can see that on the YouTube video. Why every time you are bothering yourself by clicking the picture? Try to understand the things.
Okay.
Is it okay?
Yes, ma'am.
Yeah.
Okay. So now see, I'm trying to write again what we have talked, what we have discussed. We talked about GNP, then NNP at factor cost, which is national income also. Then we will calculate personal income. Then we calculate disposable income. After calculating the disposable income, you can talk about consumption, savings. Now this savings will be gross savings again. Generally we talk about gross savings only. We don't talk about net savings, but definitely you can talk about the gross and net differently. But you talk about gross savings. Now, overall GDP is expressed as Y is equal to C plus I if it is only 2-sector economy, C plus I plus G if it is a 3-sector economy, C plus I plus G plus X minus M, or Y is equal to C plus I plus G plus NX. Because X minus M is export minus import, so you take the net export. NX is net export. So this is the GDP. This is the total output. But disposable income, YD is equal to C plus S. So when you are talking about the total economy, for economy, what you are saying? For economy, what do you say? Y is equal to C plus I and Y is equal to C plus S. This is for the economy, not for the individuals. Disposable income is with individuals. So then you say because C is common in both, therefore S is equal to I. And this will be identity. This will be in form of identity, which always remains the same. So saving and investment are always assumed to be same. So this is for macroeconomic equilibrium.
Hello, ma'am.
Yes.
What is NX here? Y is equal to C plus I plus G plus NX. NX means?
NX is equal to net exports.
Okay, ma'am. Thank you.
Like just for example, India, in case of India, India exports petrol and India imports petrol. So when you are talking about your total output, what you will do? You will deduct the imports from your exports. So net export will be positive. Net exports will be positive if export is greater than import. NX will be negative if export is lesser than import. So like suppose you talk about pulses in your country or edible oil in the country. So edible oil and pulses are an import item. So you import also, but at the same time you export also. So you import more than what you export. So in that case, NX will be negative. Similarly, yesterday also I was telling you, when you talk about factor income from abroad can be positive and negative both. Positive if you are getting more remittances from outside countries as compared to what foreign nationals are taking out from your country. So in terms of foreign currency, every transaction which has a foreign currency involved, there will be an outflow and inflow. So generally you take the net amount. You don't take the total amount, but you take the net amount.
मैम एक क्वेश्चन है.
बताओ.
मैम जो पर्सनल इनकम का कॉन्सेप्ट है, क्या ये किसी कंट्री में जितने सिटीजन्स हैं उनके सारे उन सभी के पर्सनल इनकम्स का एग्रीगेट फॉर्म होगा?
हाँ. The income which is actually received by the individuals. Okay. That is personal income. The income received by individual, like suppose what happens that government spends a lot. Government spends on education, government spends on hospitals, government spends on roads, creating infrastructure. But every money is not coming to us. Only the money which is directly coming from the government to us in our bank accounts, that can be added to our personal income. But the expenditure which the government is making, that is part of your GDP. So transfers which government is making to us will become part of our personal income, not GDP, but other payments, other expenditure which government is making is part of GDP, not the personal income. That's how. So next class we will talk about the 3 methods of national income accounting. So we will start with income method of national income accounting. Income method of national income accounting. Okay, thank you.
Thank you, ma'am.
थैंक यू मैम कल रहेगी या फिर मंडे को
थैंक यू मैम
Monday.
ओके मैम थैंक यू मैम
Thank you, ma'am.
Thank you.